Hello everybody, this is Steve Garai from Keller Williams Urba. It is my distinct pleasure to have Alphonse Negro with us once again. You may remember him. He is the specialist in mortgages at the BMO. Al, I have a special question for you today, and welcome, by the way. Pleasure to have you.
Nice to be back, Steve.
Now, my question is the following. It's in the new construction market. If I, as an applicant, decide to buy a new condominium, and delivery is set for 2 years down the road, I have to fill out a preliminary contract to access this property in 2 years from now, and the developer will have a relationship with one of their financing partners, e.g. a bank. Now, increasingly we've been hearing that people who are undergoing this process have to re-qualify after they've signed this preliminary contract, and if they don't meet those conditions, they risk losing their deposit. I was wondering whether you could help clarify under what circumstances this can actually occur and what the applicant can do to protect themselves.
Well, Steve, that's a great question, because the market consists of new construction and existing pre-sales. Now, normally, when you're buying an existing property, you run into your bank, they secure your rate for 90 days or 120 days, you meet the conditions. But here with a developer, you're buying something that's in the future. Delivery will take place in 12 months, 18 months, 24 months, and maybe even 36 months. However, what you need to make sure is that your rate is secure, but that you have also met all of the conditions to financing. Now, I can assure you that the developer will encourage you to go and see the banks that they are working with, and please do so, because in your interest and your benefit, they have already made arrangements with their lending partners to secure financing for you. Now, what will happen is that you have to ensure from the time of signing the preliminary contract that you run into the bank and you get yourself approved. Not pre-approved, approved. That means that you have met all the conditions to financing and you don't have to wait until delivery date. When delivery date will come, then you can shop around and see with your lender, your normal bank, whether the rates are competitive at that time. Please do so. However, what you have to make sure, though, is that should there be a delay in delivery and you have exceeded the delivery date, you will have to run back to your bank and ask them if you are still approved. They will have to open your application again and qualify you. This is where the danger rises. And the reason for it is that maybe your circumstances will have changed. Maybe interest rates went up and now you have to qualify at a higher rate. Maybe there is a change in your financial circumstances where you've taken on more debt, and that may not qualify you for that mortgage. There is a case right now that I've experienced personally where delivery was April 1st. Client had applied in 2012, and the gentleman went back to the financial institution to extend their approval. They said no. CMHC said no. In a panic, a realtor found me, and with my experience, we were able to salvage that deal. Actually, that was a good deal. The lender should not have said no, but you always run that risk. Make sure that you've met the conditions. Don't take on any debt, any new debt that you cannot manage until the time of delivery. This is the best assurance that I can offer. Thank you, Steve.
Thank you, Al. Great advice.
Thank you.
And thank you, dear viewer, for having watched. Until next time.